trying to multitask here. But I'm going to talk about what I think is a new investment paradigm, and that's driven by a weaker dollar, fiat currencies, stronger gold, silver, commodities, international and emerging markets. And uh, this year, what we've had is a big move in the S&P off the low in March, and basically the S&P went up 41%, 41.5%, and it looks like it peaked out around October 31st. And right now, the valuation on the S&P 500 is a 41 CAPE ratio, which is close to the all-time high of 43 at the peak of the 2000 boom. So valuations are at historic highs. We've had a big run in the stock market. Here's another look. I find it is very important when understanding bubbles and the like to take a long look at look at markets over the long pull. And in the 90s, we went up. We peaked in 2000. It wasn't until 2009 that we bottomed. The S&P, the SPY was down 57%. The S&P with dividends down 52 or something. But then we're up ninefold, and that is a big move. We've had a big, great earnings in tech and all that. That's all been good. The U.S. economy. But right now, we also, one indicator is that we have an inordinately high level of debt, margin debt, but that's also coincide with historically market peaks. So be careful, because once you start selling and then you've got margin, you have the feedback loop of forced selling, which adds to the panic, which then leads to futures. It can be a feedback loop on the downside. Another way to look at this market, I mean, if you think from an asset allocation standpoint, historically, when we're trading the S&P 500 at 22 times forward earnings, the average return over the next 10 years is low single digits, let's say -2 to +3. So asset allocators, and I'm thinking from a global standpoint, the S&P has done great, 10, 20% over several decades. But right now, it doesn't look good based upon this historical statistic. And looking at what we've seen happen in the megacap stocks, we've had these big parabolic moves. And but at the same time, you have guys, iconic, brilliant guys, Michael Burry, SoftBank, Peter Thiel, they're exiting NVIDIA. And yes, it was good. But my argument would be, we may be at a tipping point here where you're going to start to see earnings deceleration. Things will roll over, and it would be rough sledding. And what we want to be is allocated elsewhere. And some of the economic concerns, we have poor consumer sentiment, but the market's at highs. We're seeing weaker employment numbers. That's a concern. And outside of talking about like gold mining per se, there is good momentum, good returns now being generated in the foreign stock markets as well as the emerging markets. And that's really kind of a consequence of a weaker dollar. And again, I think that means that longer term money flows, if I'm allocating money in the US, putting instead of 60% into the S&P 500, maybe put 10% into foreign, 10% into emerging markets, 10% into commodities. And then you're going to have a diversified, better outcome or expected return. In terms of gold mining stocks, the returns that we have seen this year are really eye-popping. I mean, everyone's very comfortable making good money in the S&P and 20%, that sort of thing. But you're up 129% on the GDXJ. That's the junior gold miner ETF. You're up the GDX 125%. Silver itself up 74%. Gold shares themselves. And the stock that I bought, almost 5 million shares of Blue Lagoon, it's up 300%. Now, we picked it up, a very good time. We're very excited about the prospects. I'm going to talk briefly about it, and Mike White can chime in later on it because he was the investment banker on this deal. But, I've endeavored as a CFA, I never worked actually doing the building models at a big firm, but, by my estimates, what we will see and got a lot of kind of management feedback, is that they're going to start producing ore. It's going to start at around 100 tons per day, and then that will be processed. And that process, the number of tons per day, TPD, will go from 100 to 150 tons per day, and then ultimately to 200. And I assume $4,000 per ounce. And I just calculate out where I think that the cash flows will be. And I could see at the end of the year, the stock being in the $1.50 range, which at 45, 50 cents where it is now, that's a triple. And I just feel like I'm looking at a construction process. I think they got the licenses, they got the funding, they're now finally shipping ore to Nikola. And but what they put out a press release a week ago, and they basically said, well, the first shipments are going to be lower quality. And so I'll just call it 4 grams per ton. And if it's 4 grams per ton, people are going to be disappointed. I thought this was a high grade mine. Why am I not getting 10 grams per ton? Well, that's because they need to build an infrastructure of tunnels to access all these gold veins. And that means the rock that's coming out has some lower quality rock in it. And so I just said, and it was described, typically you'll, let's say, go 1 meter wide, but to move the carts back and forth that are going to excavate or remove the rock, you're going to need a 0.5 meter on each side, so double that size, but it's not going to be the premium cut 10 gram per ton gold. But that'll all be done in 4 to 6 weeks. And that the clock started on that about a week ago. And so we'll see that happen during the course. Anyway, we'll start to see, in January, February, it will no longer be 4 grams per ton, but it will probably go back up to about 10 grams per ton there. And I use 10 grams. You look at the 43-101, it's 9 grams, but they don't include the silver. I'm just rounding it because I think it's an order of magnitude issue. But then they actually have other veins that are higher quality, the argillite vein, and they'll probably start hitting that in April. So what you're going to see is the quality is going up and the volumes are going up. And so as the year passes, you're going to see a consistent high growth rate. And what's going to happen in the summer is, well, then they're going to go from 100 tons a day to 150, and then hopefully to 200 tons per day. And that brings us to the other part of the story, which is not understood well. Mike White had actually kind of pointed to this, and I had to try to get my brain around it. But, a gold mine can be evaluated by the cash flows produced by the existing mines. But there's another way to look at it, is what is the value of the resource? And in this case, what's very exciting about Blue Lagoon is you got Quentin Hennig saying this could be a huge opportunity. It's like Pergora, it could be like Buritica. But they have only explored 10% of their property. And, I'm not a geologist, and I'm not used to reading these things, but they had these pictures. And I had somebody from the mining committee spend some time going through them and explaining them. And what they're saying is, here's a mine. This is the one I was in. I think I'll show you a picture of me there. Maybe Mike White's in the picture too. But then, this is where, the mine entry is. But it's these other areas. And this 18-kilometer strike, this has potential. Right now, we're talking 225,000 measured ounces. They think that based on already results they have, they've got 1 million that they'll be able to prove as they just do more drilling throughout the year to get to 1 million ounces. But that is just for this whole Boulder vein system. But there are these other areas, and this is what they're going to start drilling into starting in March. And so you have a operating story that is accelerating. And I think you could see, very rapid growth there. But then you're going to have these guys start drilling into the ground. And just going back, the big story was I talked to somebody on the mining committee, Yanni Citos. They said, it looks to me like, you build a second, mine in 2026 and then another one in 28, and then maybe get bought out by a major company in 29. He said, I think it's going to happen sooner. I said, why is that? He said, well, in September, there was a conference in Beaver Creek, and it was an industry conference, and 33 people did one-on-ones with Blue Lagoon, and 3 majors showed up. One of them with 6 people, and I don't know the name of it, but my understanding is it had about a 70 billion market cap, which relative to a 70 million market cap company for Blue Lagoon is 1,000 times the size. And they're showing up to talk to Blue Lagoon. And Blue Lagoon, Ronovic's like, nice to meet you guys. Why are you talking to us? They said, we mine in British Columbia. We like working with a regulator. We understand it and all the other positives about British Columbia. But you guys have a 17 or 18 kilometer strike that is unexplored, and the cash flow that will be produced by these ramping production numbers will be used to use one of these diamond tip drills to go into the rock to identify where all the gold intercepts are, so then they can put this and define the actual scope of the resource over the next 2 years. And you'll go from 225,000 ounces to 1 million ounces, maybe to 2 to 3. And as they start drilling these other ones, maybe it could be 5 million ounces. I mean, you got 1 million in 10%, but we don't know. But what we do have, we have these photographs. These are magnetic drone images. And this is what the smart guys look at. And, you have these 2 areas, the chance structure, and there's another one, and it just they're sending these signals that there could be something that's meaningful here. And so it may be 2 to 3 million, but maybe it's 5, maybe it's 10. Certainly Quentin Hennig said, I'm not going to go out on a limb and say it's another Pergora with 30 million ounces. He didn't say 30 million, but he said Pergora, on a video. So this has potential legs. So you got a good operating story, but you have a good resource story. Again, why I'm positive on gold and really been focused on it is that I lost a lot of money over the years, and part of it is not understanding the bigger cycles. And there's a big cycle called the Great Rotation between the S&P and commodities. Commodities did great in the 1970s. The S&P stunk. Commodities did pretty well from 2000 to 2011. Gold did great. It went up 10x. So did oil. The other areas, you had great stock markets. And I'm saying we're at the end of a great stock market. Things are peaking. And because of inflation, now you're going to start seeing commodities do well. And sometimes taking a good long-term view of things, Infotech, as a percentage of the S&P, in the 90s, it went from 5% up to 34. That was a big tech boom. Now it's went back to 10%, then tripled, quadrupled, to where it is now. At the same time, resources and materials, they've come down from 20% to 4%, so, losing 75%. And if we get that cycle move, you could continue to see flows into these resource sectors, and I think that would be very positive. And this is actually from Goldman, and this is an aggregation of where assets are. 55% is in equities and 70% debt and cash. But what I'm starting to see people say is you should probably have 5 to 10% in gold. I mean, equities aren't supposed to do well. I already showed you. Debt, U.S. Treasury bonds, not so great. 4%, big whoop, and cash. Well, if the Fed lowers interest rates, that cash isn't doing you much. But you just made 100% last year in your gold or gold mining indexes, so why not put money there? One of the drivers is a weak dollar. The dollar has been buttressed by capital inflows, 20 trillion over the last 18 years. And if that continues to weaken, that should be positive for gold. why do people not want to be putting money in the US dollar? One of the reasons is, well, we got 38 trillion in debt. We have several major countries with fiat currencies, and uh, gold actually hedges well against it. And so you also have foreign central banks putting money into gold. Again, I think that we may be at a tipping point. I got this from Katusa, but basically you get to these extremes when you compare commodities versus equities. And right now, everybody's all in on equities, and you're getting in at the bottom. And if you time these moves, the returns to your customers can be enormous. And that's what I'm trying to do. Now, with regard to bonds have always been the great safe place. You get your money back, yada, yada, yada. But people also buy these 20-year mutual funds with 20-year maturities. But, if interest rates are moving up as they did from 2000 to 2023, they actually did terribly. People don't understand duration risk. And suddenly, well, people don't want to, international investors, why do I want to own US treasuries? Well, not much of an argument for it. But there is a good argument for owning gold. And what we're now seeing is that foreign central banks are owning more gold than they are US treasuries. And this should continue. I think you're going to continue to see foreign banks be major buyers of gold. You got to bid in for gold, and that's good for gold mining stocks. My own technical analysis, I looked at the history of these moves. You basically have a five-fold move here in the 70s. You have a five-fold move here, and another five-fold move, if you were to project it from its low, let's say 2015, gets you about 6,500. We're not there yet. I don't think that we've seen the craziness yet in gold. And in fact, this is from Crescat. They're good people out at Denver. And the ratio of gold miners to gold, suddenly you're starting to see gold miners relative to gold are starting to do better. And I think that, if you're in the right names, which I would argue would be something like a Blue Lagoon, but there are others, you could really have great returns by being in the gold mining space. Well, gold's up 100%. We missed it. No, you didn't, because the price of gold went up. And frankly, this is a couple months old, but the GDX, which is a ETF of gold miners, trades at 11 times earnings. And the crazy thing is, even with it up as much as it is, with gold being up like 60%, the multiple hasn't declined. And so there is still more upside. And relative to how people have allocated, we're still down in that 2% range relative to being up at 8. So arguably, if this is a major cycle, you could see several years that are very positive for gold miners. Here on a long-term basis, I think this is very helpful for perspective. Excuse me. Since 2009, gold is up 252%, but the GDXJ, the Junior Gold Miner Index, is up 10%. How can the two not be more closely correlated? I think it's a lead lag issue. Gold goes up, all these dormant miners, suddenly they'll start making money. And this is what we're starting to see. More capital is flowing in. People are starting to expand, and earnings are going to be there. And so, I tend to push towards more aggressive scenarios. So I like the junior miners. That's where the big opportunities are. And then one other phenomenon that I mentioned talking about is there a bubble in AI? I've spent a lot of time looking at bubbles. I got out at the top in 2000 and still managed to lose money because I got back in a couple years later. And I didn't study bubbles. And it wasn't until I started reading Robert Shiller and John Kenneth Galbraith. And Galbraith says it very articulately. He said, all bubbles are very similar. A new idea casts a spell. Credit expands, prices rise, everybody feels smarter, then crack. Reality bites and it all comes crashing down. We all probably remember, or I certainly did, I found it in 2003, was Rational Exuberance by Robert Shiller, but he wrote it in March of 2000, and he called the peak there. using the CAPE ratio amongst other indicators, but basically behavior was bubblish. And he wrote another book, Irrational Exuberance, and it was on the real estate market. It was in 2005, before the huge collapse. And to me, from what I've seen, this feels very much like we are in bubble territory. Maybe NVIDIA had good numbers now, but I think you could see potentially a deceleration. But at some point, that thing is going to break, and when it does, I think things are going to get worse. One of the fundamental issues that we're seeing that is indicative of bubbles is suddenly the amount of debt being used to finance the capex to drive this big AI infrastructure, and that's gone way up. And we're seeing funny kind of circular finance. I mean, is it demand, or are the structures, everyone's just buying their own revenues? And that also is indicative of a bubble. Lastly, part and parcel with this AI stuff, I think you got crypto. And to me, that looks like that could be a bubble as well. And it looks like maybe it just cracked. And given its volatility, if that continues, I think you could see it pull back a lot further. That there's a lot of money that tends to be momentum oriented. And if that starts cracking, I see that putting pressure on the NASDAQ and the market in general. And I think that that's a risk. So this is me. And I'm not going to take questions right now. What I want to do is I want to go to Mitch Belagic, and I'm going to stop the share. And Mitch, I think I got you set up so that you can put up your presentation. Mitch, are you there?
Yeah, I'm here. Can you hear me?
I can.
Okay. I'm just going to very briefly talk about two things that are really on my mind now. One is some interesting developments and things to watch in the bond markets and related to bond markets. As always, the best indicators and the best things to watch, especially in market turning points, which we could be at, maybe, maybe not. Second subject is I'll take a little review of AI. This is something that I do for a living. Where do we stand short term, some indicators, is it a bubble or not? But more importantly, taking a longer term view to really understand AI. So let me start with the bond indicators, just go very quickly. One thing that I always watch very closely is the MOVE index. That's the VIX version for the bond market, primarily following the 10-year. And there's always, this is an inverse relationship. So basically the bond volatility has been always very precisely leading any turns in the S&P. And right now, possibly, not conclusively, but possibly we could be at that point. Very important to watch the MOVE index. Second thing is, it's also a possible party breaker is I follow closely the Japanese bond market, and there's been some interesting development going on. Like the MOVE index that I just mentioned, made the recent low just when the Japanese 30-year reversed higher again. Despite the fact that the 10-year US hasn't moved since early November, US bond volatility has continued higher. It's moving pretty much in lockstep with the Japanese long end. Watching the Japanese market is absolutely tearing the Japanese bonds. I mean, they're at 1.8, I believe almost 2%. Doesn't sound a lot, but since where they were and how that's going to impact the global bond and equity markets, it could be drastic. I'm not even trying to assume or calculate the carry trade here, but that could be also another factor that people might be bailing out. And this is actually U.S. versus Japanese 30-year gap.
Do you have a presentation? Are you showing that?
Yeah, I am.
Does everyone see a presentation?
No.
No. Oh, my apologies. Hold on a second. I probably didn't press the right button.
Mitch, by the way, was a quantitative strategist and now is doing much more work in the AI space. So he's a former currency trader in Hong Kong and, one of the other kind of macro experts we have on. So just
Okay, can you see my chart now?
Yep, we can. Okay,
Okay.
broken.
So yeah,
broken. Start from
broken.
the top.
So the move index, always inversely related to S&P, it literally always leads in a way. That's why I always watch it closely, because volatility in the bond markets always causes havoc in the equity markets. And I transposed here the move index versus the 10-year and the Japanese 30-year. The Japanese bond is just tearing. That's what I mentioned. So this is something to watch. So the volatility is picking up, and the 30-year Japanese has been really on the tear. The volatility on the U.S. bonds comes in first. So now this could be also pulling up the yields much higher in the U.S. And this is the relationship right now between the Japanese 30-year. Let me blow it up a little bit just so. And the US 30-year. So something has to give, given the volatility in the bond index and given the tear of the Japanese bonds, all the indications that volatility will influence the US equity market, and bond yields could be going higher because of the Japanese factor. And of course, this has implication on the dollar as well, because parking money in the dollar is a nice option when volatility starts spiking. And now, as we're seeing the both VIX and the move spiking, it pretty much explains the dollar. And lastly, Tyson's favorite, relationship between the Japanese 30-year and the gold is a perfect correlation, maybe incidental. But I did read something from Albert Edwards that pointed out earlier in autumn. This is not a spurious correlation, but reflects the increasing subservience of monetary policy to fiscal dominance. So everything said there. Now I'm going to move on to the AI. Maybe spend a few minutes more on that topic. First, related to the bond market, something that's actually came across. We talk a lot about capital expenditures in the MAGA stocks for AI and whatnot, but
MAG, no politics.
MAG, yeah, sorry, MAG. One thing that I've been noticing, that credit default swaps have been actually surging on these stocks because there is some concern in the marketplace about the spending. And also there is an assumption that capital spending will not be able to be sustained by these companies, mostly because they're going to have to actually seek money from outside. And there's a definite concern in the marketplace. What the credit default swaps are saying is that this is not going to turn out to be good. So speaking of that subject, by default, we start comparing, well, what is happening with China? If this is happening in the US, what is the China AI race looking like? And why are we spending so much money on capital expenditures? And is this really necessary? Well, China has proven to have their capital expenditures are 82% less, like a fraction of the US. Now, Jefferies analyst Edison highlights that Chinese hyperscalers are going to spend about 124 billion on capex in up to 2025 by the end of this year. While the Chinese AI models like Minimax M2 trails the best US model GTP5 only by plus or minus 10%. Now, this is something that I follow, and it's a factual. We even do testings on this and analysis, and we still have difficulty understanding why is US AI better than the Chinese, except that we're spending 6 times more on capex. So maybe that is one of the reasons why the credit default swaps are screaming, because maybe they're comparing us with China and saying something's awfully wrong here. Then again, let's talk about execution, data centers and electricity. Huge factor in the US. And this chart here just is showing where China is in growing its electricity capacity versus US that is pretty flat still. So we got a lot of talk, but really very little action. So to look at the big picture, going back to the US-China race, US has a little bit of dominance, like 44% of global data center capacity still in the US, but that's dramatically changing, especially that US spare capacity, power spare capacity is declining and approaching the critical threshold, which is 15% considered by 2030. And as this chart illustrates, China is taking this very seriously, and they're really delivering on the power capacity. In the US, but besides the cost issue and a lot of legal and development issue, we still want to see some action versus talk. Now, that's pretty much the situation as I see it going short to midterm. But one thing about AI is Tyson mentioned these cycles, boom and bust cycles. They apply for AI as well. And one thing that's very misleading, when we have this Gartner hypercycle is pretty much intact for any hypercycle, including AI, just like Tyson mentioned. But one thing to keep in mind here, looking at the long-term picture, the incredible emphasis in the initial cycle is on the supply side, on the NVIDIAs, Microsofts, and whatnot. And yes, they're at a bubble to a certain extent. Is it a imminent bubble? Is it a small, large bubble? No one really knows because there's no benchmark evaluation. But what is missed in this whole picture is looking on the demand side. How is Main Street, America and Europe and the whole world implementing AI? And how is they going to kick the productivity cycle? And that is already happening. That's regardless of overvaluation of NVIDIA's and the rest. This is something to follow because eventually within a year or two, there's going to be tremendous difference between who's ahead of the curve and who's behind the curve. And one thing that strikes me, that generally the analysts on Wall Street have still very little clue how to value companies and their implementation and use of AI, which is going to be also a huge problem because misses are going to be tremendous. So going back, is it a bubble or not? It really doesn't matter because eventually AI is here to stay. If you're following the demand side and the productivity and development of the Main Street, that's really what matters in the long run. Just like it happened during the internet boom, during the computer boom, they all eventually had enormous productivity gains. And if you understood how this new technology going to be implemented and how they're going to change valuations of company, made a huge difference in the stock picking and portfolio building. That's pretty much it. I kind of threw this on a couple of charts on my Word documents in the last hour or two. So
no, that's great.
Very much structured, but just
Mitch,
kind of two things.
Do me a favor and send me a copy of that so I can I got some requests for a summary of this and I want to use some of your charts. Sure. We're running behind. We have just so much great content. I want to move on and have Mike White speak. Mike, are you there?
Yeah, I'm here.
Do you have a presentation? You want to just
no? I'll just
use that silver tongue of yours. Tell everyone a little about your background, your position, your history, and then fire away. Try to think about 10 minutes, and I'll let you know as we approach the end of that.
Yeah. Okay. Just looking at the time here. Okay. Yeah, that's fine. My name is Michael White. I'm the president and CEO of IBK Capital Corp. We're a boutique investment bank located in Toronto, Canada. We were founded out of Merrill Lynch, Canada, back in 1989. So we're over 35 years old now. That was due to Merrill pulling out of Canada, which it's done time again. At that point, it was a spat over credit cards in Canada, and they left. And the corporate finance mining team decided to stay in Canada, and a handful of them opened up IBK Capital. And that name just simply comes from what they were called at Merrill Lynch. They were called IBKers or investment bankers, IBKers. And so their clients said, well, you're the IBKers, whatever you do, we'll follow. And that is what formed IBK Capital. The focus is mining, as the original team was focused on mining. I joined in 1994. Over time, I bought out the partners, and now I run it very much as a boutique investment bank / family office. That's because we're a little bit different than our competition or peers, if you want, in that we don't just transact, we don't just find deals and put together financing for deals. We invest our money alongside of our clients' money, and in many cases use them as sort of a litmus test to make sure that the opportunities that we've identified don't have any glaring red flags that we've overlooked. And so it's a good relationship with some of our older key buy-side clients. We very much deal in the junior space in mining. It's about 90% of what we do, mainly on the exploration side, but also development and some production. We deal in jurisdictions that have the least amount of friction. So we're a little bit agnostic, but we want to deal in places, for the most part, that we know we can do business in, both from a regulatory standpoint, but also from a social license standpoint. And so I'll go through some of the transactions that we've done in the past, but we find that life is too short. And as I get older, that gets more and more emphasized to my core. And it's in a backdrop where mining, things just seem to be getting longer and longer in terms of lead times. And so we want to be in jurisdictions that have the least amount of friction and we can get business done. So in terms of metals, we over the past 30 plus years, we've mainly dealt in precious metals and I guess what are now called critical metals. Back in the day, they were base metals. And we're very comfortable in that space, in particular gold, silver, copper, nickel, more recently lithium and some cobalt. And I'll talk a little bit about lithium in a second, but certainly precious metals and nickel and copper. We in the past have been very fortunate to been on the early side of some of the deposits that grew into well-known household names in this industry. We always celebrate when our clients graduate, as we call it, and that's where they go through $1 billion worth of value. That at that point it becomes too big for us, and so they're passed on to others in terms of investment bankers and such to do the work. But we've been very fortunate with a handful of discoveries over the years, and also development of mines over the years. Some of our success stories include going back to the last cycle, the Mesquite mine. That was bought out by New Gold. We put that back into production with Western Goldfields. It was bought out for $282 million. That was a 35-cent transaction that went to $13. So we were very pleased about that. El Chinate gold mine in Mexico that was owned by Capital Gold. Ultimately, it became part of Alamos Gold. It was a buyout for $420 million. We also worked with Alamos Gold more recently on Manitou. That was a buyout of some property they had beside the Island mine. And so, we continue over the years to work with Alamos. The Windfall Gold Project in Quebec, that became Osisko Mining. And that was ultimately bought out by Goldfields for $2.16 billion. The Detour Lake Gold Project, we work very closely with Ingrid Hibbard and Palangio to develop that. And when I say we worked with, this is sort of in the early days, when these projects are being conceptualized, when they're completely overlooked by the market, or when an asset becomes available and it's been overlooked by the market and we can pick it up for cheap. This is what I mean by when I say we, because we do work very closely with our clients in this regard. And we love it when we see this disconnect between value and what the market is perceiving as value, what we see as value and what the market is seeing as value. So, I mean, Detour was a fantastic transaction that was bought out by Kirkland Lake for $4.9 billion. It was the largest gold producer in Canada. We've identified that very, very early on. Great Bear back in 2019, I think it was. That was a company that we were following. It had a Red Lake gold discovery in Ontario. I can't say enough about Chris Taylor and his team. They did a wonderful job. We brought Rob McEwen into that one, raised them some early stage capital, about $10 million. And that was ultimately bought out in 3 years for $1.8 billion by Kinross. So again, a fantastic trade, but great asset, unknown, overlooked, and then this discovery was made. We also more recently worked with with Mark Selby on the creation of Canada Nickel, and that is up in Timmins, Ontario. It will become the largest nickel mine in Canada and will rival some of the large mines in the world. That was just highlighted as one of the large critical infrastructure projects being backed by the federal government of Canada. So they're on their way. That puts Timmins clearly on the map. Timmins is a gold producing camp. It's also a base metal producing camp with the Kidd Creek mine. It's produced 72 million ounces of gold, the district. It's very friendly. You can do business there. It's fantastic in terms of your social license, your environmentals, dealing with the government, both municipal and provincial. And now the federal government has stepped in, which is fantastic.
That's a great history. How about Blue Lagoon and your favorite picks now?
So I was just getting to that. This is all a lead up to that.
Go ahead. I'm sorry.
Yeah.
Take your time.
So the next one that I was going to get to was Blue Lagoon. And Blue Lagoon was very interesting to us because as Tyson has already gone through, we see it as tremendous exploration upside. We see it as a series of parallel veins that have very, very long strike lengths, and it could host. This is arm waving, and there's a lot of work that needs to be done, but it could be district scale in the sense that there could be 10 million ounces of gold once it's fully explored, right? Or more. It's just that type of geological environment. We had when Ranavig first came to us back in 2020 or so, he was wanting to fast track it into production, and BC is not an easy place to do business. I would not say that it's a place of simple, of little friction, I should say, of easy permitting, but you can get things done in BC. It's been proven time and time again. You just have to have the right team and the right approach and the right relationships. And Ranavig had that. He really did. He showed on many different levels with many different stakeholders that he was bringing everybody in line and having them want that project to go into production. So we said, we're not huge fans, at least I should say back in the previous cycle, we weren't huge fans of small production. I think small production, I'll get into it in a second, is going to become critically important going forward. But when you combine what they've done on the production side, which, as Tyson said, is going to grow, there's also some permitting hurdles. If they get beyond that, they'll be able to expand even further than what Tyson was talking about, so they can grow, even more. Certainly, the mine is capable of being expanded. So there's ability to grow that production, but at the same time, we are very much pleased with the idea that they're going to continue to explore, because that will be your the production underpins the value. The upside, the real upside in terms of multiples, will be in exploration discovery. And when I say multiples, that's where you go from Tyson's model of, say getting to $1.50, suddenly the stock could be at $3 or $4 based on a couple of drill holes coming back with some good gold in them, because that's just the way it works. It's called the Lassonde curve these days. when you're on the leading edge of exploration and you have a discovery, sometimes more money is made in a shorter period of time than you see in years of worth of production following, you know, that mine actually going into production. So a lot of money can be made very early on. The fact that they're in production also will limit, we believe, as Randa does, dilution to the shareholders. We like that too, because typically exploration discovery is constantly needing to raise money from the capital markets through issuance of shares. So we like that it limits the dilution, which further compounds that potential upside swing if they have the exploration discovery that we believe that they will have. So, you know, that is definitely one that we're excited about, and for maybe slightly different reasons than Tyson. Like, we take a slightly different approach, but certainly a very, very strong name, and we're excited for the exploration on Blue Lagoon. And like I said, I can't say enough for Randa Big. He's an excellent operator. So
how much do you own?
Pardon me?
How much do you own through your firm or customers?
Oh, firm and clients. I mean, I haven't spot checked it, but it's in the millions. Yeah. So
I'm sorry?
A couple million shares.
So like 2 million shares?
Yeah.
So that'd be like a little over 1%.
Yeah, not just us though. Not just us.
Correct.
Yeah.
But Mike, I'd like to call you after the meeting about a project that I'm involved with that definitely needs help.
Tony, we'll make that happen.
Yeah, for sure.
That was
no
one of the
problem.
reasons. He
No
knows
problem.
about your background, and but do you have any questions, Tony? As a former
No, look,
mining-
I mean, look. I'd make the following comment. First of all, I'm very bullish on gold long term because I think for the reasons everybody else is. But I'd like to warn you that in 2008, gold initially did very well, and then it had a very sharp break, followed by a very sharp recovery. And I think you're going to get this break again. The reason being that the same people who own gold stocks also own AI stocks. And as I will say, I think AI is worse than a bubble. I think OpenAI is Enron 2.0. So if there's a massive liquidation, it's going to initially hurt the gold market and the gold stocks too. But you know, I mean, that's life. But I would warn people about potential dangers near term.
Thank you. I want to go on to Chang Q. We will have more Q&A later. Tony has a lot of expertise in the mining space, and I'm glad that you will be talking to Mike White. Chang Q, are you there? I found the presentation, so I can share it.
Yeah, you can pull out the presentation.
Okay, let's see how good I am with this. Hold on.
Hey, Tyson,
Yes.
I need to attend to something else, so I'll
Go
join
ahead,
later.
Charles.
Yeah, let Charles do first.
Oh no, I need to go right now. So.
All right, I'm sorry. Too much content, over-contented. And
See you guys at the next
let's
one.
see
Bye-bye.
here. Okay, thank you. I'm trying to
While you're doing that, can I ask Mike a question?
go ahead, fire away.
I'm
Susan.
new to gold mine stocks, so I love hearing success stories, but I'd like to know how many failures do you have for each of the success stories?
Yeah, again, we've been fortunate enough to I guess, track your venture capital model in that sense. So, you invest in 10 companies, you hope to have one or two winners. You hope that, 7 of them are, you make just a good return, whatever that might be, maybe just your capital back, and then no more than one failure. So we have had a few failures along the way. We try not to do that. We have a saying that perseverance pays. And I really mean that. So one failure that we had was China Diamond, and I can talk to you offline about that. Anyway, it was a
I
failure.
just want to know where
Yeah.
Blue Lagoon fits in this.
Yeah. So no, Blue Lagoon, we're looking at Blue Lagoon as being a performer, as being, one of two companies that does really well. We've got others in there, like Arizona Gold and Silver that I mentioned, that I didn't get to. But in terms of perseverance pays, we have one called Loyalist that we've repurposed out of Papua New Guinea because it failed in Papua New Guinea. And we're building it back now by buying gold projects in Timmins. It's a buy Timmins strategy. And it's because of Timmins, which I already talked about with Canada Nickel, is back on the map. And there's also Tony McCooch in there with Discovery Silver, Rob McEwen with McEwen Inc. and his Fox projects. So we're bringing Loyalist back from the brink because we just don't let these companies go. So we very much try our hardest to even if there's something that has failed for whatever reason it's failed, we try and bring those companies back with new projects, new jurisdiction, whatever it takes. Right.
So Mike and Susan, I'll talk to you guys offline. Cheng, does everyone see China high quality growth?
Yes.
Okay.
Yeah.
Cheng
Okay.
Q,
This was,
he's a. Do you want to just talk about your background? He actually in 2003, I found on First Call, and he liked all these Chinese stocks after the tech bubble, Sina, Sohu, NetEase, and they're all trading at about cash and just about to turn profitable. And everybody on Wall Street was dumping them because the volume was so low. But he used basic fundamental analysis that these things are cheap as hell, and this internet thing is great. And they went up 100-fold. I bought them; they went up 30%. But the idea here is, there are cycles, and he has a PhD in Columbia Business School, and he's worked at IBM, but he's ethnic Chinese and understands what's going on there. And it's great to get a fresh perspective. So fire away.
okay. Yeah, this title, China High Quality Growth, I kind of thinking put in a question mark because that's the goal for the China's recent 15th 5-year plan. You can move to the next page.
Okay.
Yeah, in the October, basically China, they did their so-called fourth plenary session of their 20th Communist Party Central Committee meeting. And something actually very big happened. One thing is, top 9 military generals got detained, and including one that's like number 3rd guy in the military, is vice chairman of the military commission. And a lot of basically right now is not, I'm not sure, or people not sure what's really going on, but those 9 people are all were all promoted by President Xi Jinping to their top position. And also one of them was the top commander for the China Eastern zone. That's basically in any conflict with Taiwan or even with Japan. So basically, all those top leaders, top military leaders, get sacked in the October session, and the implication for this is Basically, some said the supreme leader, Xi Jinping, his power is as solid as a rock, which means he can basically sack whoever he viewed was not loyal or not to his like. So even those people who are, who were promoted by him get sacked in this time, and so those people along those lines kind of thinking he will be in power for at least another 6 years, because one more years left for this current term, and he may get another term or even 2 other terms. So that's the on the side people say, his position as solid as rock. The other side people basically said, even his loyal military aides get sacked this time, maybe his power was weakened. But judging from all the because after the meeting, all the top officials in China, they publish writings on the China Daily, and judging from those writings, looks like Mr. Xi's power is solid, because it looks like everybody's still writing trying to show their loyalty to him in that sense, including the number 2 guy in the military.
Do you think that they're still poised to go after Taiwan? I
think the third implication is maybe Taiwan will be safe in the short term, because all the top guys get sacked. Right now, you don't know who are in the military who can really go and command a war against Taiwan.
Okay, you don't have any insight into why that is. It just happened.
Well, what happened is basically people saying she viewed those 9 generals as not loyal to him anymore. They are forming, even though he promoted the top 2 guys over that circle, and those people, they promoted other generals, and they form a circle, and they kind of in the private, they joke said, even though we all listen to Chairman Xi, but actually I'm the real commanding guy here in their private circle. And those words get somehow passed to Mr. Xi. And he kind of thinking, those people are not loyal to him anymore.
Interesting. Do you get any comment with regard to that market and the economic recovery or the status of it? I keep on hearing China's not doing well.
Now,
and then we'll go to questions.
Yeah, let's get to the second general topic of
I'm sorry. I didn't. You have more.
To the 4th plenary session. The second topic of this meeting is they basically discuss the 15th 5-year plan for China. And if you read that plan, basically they emphasize they will try to achieve quality growth. And the implication of that is, GDP growth may not necessarily a target anymore. So they want the quality growth, which means they put fairness, people's happiness. That's according to their words, and also good environments. All those things into consideration. Okay, in terms of this high quality growth. Another thing they tried to emphasize is to encourage innovation. They basically try say. We want an innovative economy. We want to be self-reliant. We want China to be a big market for him. Even the foreign market are restricted or closed to China. So that's the other emphasis on innovation. Now, the question here is more like, who will be making the investment decisions is, in the past, with the reform in the past, it's always say, China will become a market-oriented economy, which means the important investment decisions was made by individual companies or private enterprise. Now, with this Xi's power of the last 12 years, he basically shifted more and more towards backward, towards the planned, kind of like a planned economy.
You want me to go to current status or no? Not yet.
Basically, looks like the party or the government are making the investment decisions. So here the worry really is, will China going back to the planned economy over the next, if he is in power over the next, 5, 10 some years. Okay, so that's another thing is whether the private enterprise will be treated fairly and their rights get protected. Recently there are some positive development, like Alibaba's founder Jack Ma get he got some exposure. Looks like that's giving the private enterprise some signal. Maybe the private enterprise owners will get treated okay or something, but that could be there are still a lot of worries, because the Chinese Communist Party, they can change things in a dime, in a blink of an eye. So that's the worry. You can go to the next page.
Like current status of the what following?
Yeah.
I'm sorry, investments.
Current status.
All right, current status.
So basically, if you look at the current status of China economy, the export, the October report is down 1.1% year over year. People were expecting like 3%. And among this, one big down move is to US. US export was down like 25% year over year. In the past months, China and the US made a deal after the Manila meeting and the Xi and Trump meeting in South Korea. Basically, looks like both sides trimmed down of the fight between the two countries. China basically relaxed the rare earth control, and the US reduced the fentanyl, the extra tariff on fentanyl. So there is some relief, and also China started buying US soybeans. So hopefully that part will going forward in the next. Hopefully, if they don't have start another new fight, this will be peaceful over the next 11, 12 months. But recently, China started a fight with Japan in the last few days over Japanese Prime Minister's words about Taiwan. And China side basically suspended import of Japanese fisheries, and also canceled flights from China to Japan. And those will definitely have a negative impact to the Chinese and the Japan trade. Many of the Japanese restaurants in China will most likely, maybe some of them will close if this lasts a few weeks or even longer. Like a few months ago, when China they tried to restrict consumption by the officials, also that kind of hurt the consumption a lot, because of the officials are one of the driver for consumption in China. So this fight with Japan will not be good for Chinese economy too. And also there is a fight with Europe too. Like recently, German premier actually suspended a visit to China, and the rare earth issue and other export issue are on the basically agenda. And in terms of domestic consumption, the housing price keep dropping. There are reports of 15% of the housing apartments have negative equity. 40% was underwater. China basically, if people borrow money and say if they cannot pay, if the bank take possession of the apartment and they sell it, if they sell, the sales price is say lower than the loan amount, China's policy still is that person he still own the remainder to the bank. So in the sense, the bank is safer, but the person who has the loan is on the hook no matter what. So that's basically get China consumption very restrained, because people, if they lost job, they still need to pay with for their mortgage. And the other thing keep surface out is the high youth unemployment rate. And that's really also linked to the very low birth rate. People are willing to marry, and that all basically make China's aging population even more problematic. So that's the overall environment right now. Looks like the housing bust, the foreign export problem, and also the inside investment decision making. That's all in a sense a problem. So my thinking of China want high quality growth, but how to achieve it so far is still very blurry. Now let's go into the next page.
Okay. And let's try to wrap it up. It's
right. So I think in terms of high quality growth, China do have a few advantages in certain technology areas. As Mitch already mentioned, China have a very different AI approach. They basically they stress more on the algorithm. The AI much more energy efficient. The problem here for all the investing in China, U.S. listed China names still is the de-risk risk, because like last week, when Alibaba have some good news, and then there are reports surface out that Alibaba, U.S. basically tried to label Alibaba as a national security threat because of they may be collaborating with Chinese military. Now, given that warning, I do find a name which may people may I think people may be able to make some profit here. The name is XNET. Is listed on Nasdaq. Is a cloud service player. They make their money providing cloud service and also live streaming entertainment. Right now, they are also expanding overseas. They just guided, they reported very good Q3. They guided Q4 year-over-year growth like 60%. I subtract out one acquisition they made in June. The organic growth is over 40%. And if you do some modeling, it's easy to see they can make like 50 cents a share next year. This year is about 40 cents. The the company have a book value of like $25. The cash amount is like $4.40. And they have an investment gain of a company called Arashi Vision. That's a 360 camera provider. That company also get into AI. They are listed. They was listed in China in second quarter, and the company had Xinei, XENET. They had an investment in that company, so they have a paper gain of like $1.2 billion. So if you calculate the company's book value, is like almost $25 a share. Now the stock right now trading, I think now is under $7, but earlier when I write it, it's like $7.12. It's around their 100 a day moving average. I think I'd like to give a target of 25, because they are growing 40%. If you give it a 20 times P ratio, that's give it $10. They have like $4.40 cash. And maybe over the years, next year, if they can realize the game, maybe sell for half of the value right now, that's like $10 something there. So I think it can be a good risk reward play here. Yeah, that's it for my presentation today.
Thank you very much. Because of my bringing in Mike White and being particularly talkative, we did not have Charles Zhang. He's back on the call, and I'm inclined to go to Q&A because I try to keep these to an hour, and we're already at an hour and 15 minutes. I want to get some comments. So stop share, and we'll try to wrap this up. And Charles, unless you want to give us a 2-minute quick story, we're going to skip you and just go to Q&A, or maybe you can do it at the end.
Okay, yeah, I mean, that's fine. I'll just talk next time.
Okay, so Alan, do you want to say something?
Yep. Today I'm just mostly listening. Most of these topics are outside my regular wheelhouse.
Okay,
So,
Laura Stein, any questions? You're muted. Still muted. There you are.
Yeah. I'll just make, one comment, and that's that I just feel that gold is in a raging bull market, but I think that the next two, quarters are going to be very soft for basically, all markets. And I also want to just make a mention that just keep in mind that Powell is retiring, and with that, we don't know who's coming in, and who's ever coming in could start to monetize the debt again for gold, for assets. And that would be very bad for gold. And, nothing remains, off limits. And what happens if Trump turns around and says that treasuries could be tax-free? If that happens, that also would be very bad for gold. But at the end, as I said, gold is in a raging bull market because all governments have to print. That's
Treasury's
it.
tax-free. Huh.
Why can't they say? Why can't they say it?
Well, they can. They just lose a lot of income as a result. But thank you for that comment. And let's see here.
Just as a matter of tax law, they can't say it. They would have to pass Congress, and I don't think there's any way that would happen. This is from my perspective.
It was brought up by I spoke to some of the central bankers while I was in Zurich last week, and it was brought up as a possibility. And they're watching it very carefully. Anything is possible these days.
Well, it's Trump is, I think, about to get pushed back by the Supreme Court, and it's possible he would do it. The other thing that's instructive is that it sounds like the sources that you're quoting are not U.S. sources, which is where it would have to be for that kind of thing to take hold. I think one of the problems that Trump is really created for in a lot of the markets here is that he doesn't feel bound by law. He's broken more direct laws. He's ignored Supreme Court directives. He's done everything, but sooner or later, it's going to be catching up to him. And so I'm not confident that he can continue doing everything he's saying, but we'll see.
I just want to make then a comment to you, Alan. There's two people that I don't fight. I don't fight the Fed, and I don't fight and I won't fight the central bankers. That's that's it. But who's ever in power, whether it's the Republicans or the Democrats, printing has to be maintained. And if that's the case, gold is going to go up. It's in a raging bull market. However, as I said, I expect the next two quarters to be soft. And that's for all markets. And I just am telling everybody I belong to a Saturday investment club. Mike White comes there sometimes, and I've been telling everybody there to be extremely cautious.
Mike Portnoy, question?
Yeah, I would have a question for Mike, and his observations of your Tyson, your timeline for Blue Lagoon, and I'm wondering what his timeline might look like.
Yeah, so my timeline, as I mentioned, I'm more interested in the exploration discovery side. I really appreciate that. Let's say that the current production underpins value, especially in light of $4,000 gold. When Rana set out on this, it was much less in terms of the price of gold. So it's a unique situation. You're almost paid to wait. You know what I mean? Because that's the issue with exploration. It sometimes can take time. And you can have a lot of misses before you finally hit something. But that's what I really appreciate about Blue Lagoon right now, is that we're kind of paid to wait. And so, I can't really say when the discovery is going to be made. I just believe, as do others. Tyson mentioned Quentin, another fund manager who's involved. We really see the exploration upside.
Excuse me, I just want to jump in on Blue Lagoon because I also know the story very well, and I'm an investor in Blue Lagoon, and I know the CEO quite well. And first of all, you have to have confidence in the people behind the project. And they happen to be marvelous people. They happen to be very, very working people. They have an extraordinarily very good relationship with the indigenous people in the area. And they were, Mike, I think that you know it better than I do, that they were one of two people who got licenses in BC in order to reopen a mine, and it's very, very difficult to get a license, permits to reopen a mine. And as you said, the expansion for exploration up there is amazing for down the road. It's just amazing, and they have full control over everything.
Yeah, and just to add to that, and Mike, and to just kind of continue the thought in terms of exploration, Great Bear, let's use that as an example. They first sort of descended on their our exploration model back, I think it was 2016, 2017. And 2 years, it took 2 years of sort of drilling and vectoring and going through the various geosciences before they finally made the big discovery. And then 3 years from that point, they were bought for $1.8 billion. The stock went from 25 cents to, I think it was $28.
It was $29 that Ken Ross
29.
bought it out,
The
for.
Yes, and the discovery, when the discovery was made, it was in the hinge zone. The stock was trading around, I think it was around 50 cents at that point, and it went to $2 in a matter of 2 days, and then it never looked back. So, that is the type of situation we could find ourselves in with Blue Lagoon. And I think it was Susan, you asked, where does Blue Lagoon fit in? Is it going to be one of the winners, or is it going to be, well, we very much believe it could be one of the big winners, right? We are waiting on the exploration side. But in the meantime, we don't get diluted, right? Because he's in production, he's got cash flow. So,
And yeah, I think that that's one of the unique elements as well. But I mean, to start with, I mean, the fact of the matter is, Quentin Hennig, well-known geologist, consultant to Sprott, and certainly to Crescat Capital, says this could be like a Veritica or Progrora, 10 to 30 million ounce opportunities. And we will see. But what's exciting is they've got this underpinning, mining and cash flow story that still drives a fabulous return profile. And they'll just use the cash flow to finance the drilling so that they can do it over 2 to 3 years. And my guess is that there'll be a point where somebody's going to say, hey, they got 5 million ounces. I'm not sure whether it's 10, but we'll just pay up for it. And that's I remember Quentin talking about it one time. He said, this stock has has some real cowboy in it. And I didn't know what the heck he was talking about. But the point is, like, suddenly you could be looking at a company that looks much, much bigger and much more exciting, which is why I've gotten as aggressive on the stock as I have. And but to Susan Lee, there are other names that we can look at. We can get diversified, just owning the GDX, that sort of thing. These things are also possible. And we'll have Mike White again on one of our calls, and we can go through some other names as well. But Minaj or Mitch, do you have any questions, or Tony Lobier? And then we'll just wrap up.
I have. I'd like to elaborate a little bit on my comment about OpenAI, because I don't think it's fully appreciated. I was struck by I didn't listen to the whole thing, but on the NVDA call, the point was constantly made how great demand is. But the big problem is that you take OpenAI, which did 13 billion in revenues or will do this year, and is going to lose 75 billion in losses. And they have also done $1.3 trillion in deals. And I think that this is very reminiscent of Enron not too long ago. The difference being, I think, that they do have a product that's good. However, the financials are totally unsustainable. And I think the reason they don't want to go public is if they did try to go public, people would realize that the financials are totally unsustainable. Now, if I'm right, that the financials of OpenAI specifically are unsustainable given the circularity of the orders. I think the whole thing is in serious danger of collapsing. Now, that doesn't mean it won't come back. That doesn't mean AI is a bad product. It just means that there is a serious vulnerability here, specifically in OpenAI, which NVIDIA hasn't dealt with. And sure, if you have 1 trillion in orders that are vaporware, I mean, sure, you got strong orders, but if there's no financing for those, or if the financing collapses, you're in deep doo-doo.
Well, we've seen double ordering sometimes occur when there's a lot of demand and everyone's desperate, and then suddenly, as soon as it pauses, it collapses. And I think it's a very fascinating period, and I really think that we've had some great contributions. Any final comments, Mitch? It looks like you're leaning
I would
in.
just like to, I would just like to comment on what Anthony mentioned. The problem with OpenAI is they have a bad business model. The only way they can survive if the computing, the data centers collapse and the computing data and hardware just tanks, and that's not going to happen. So eventually, their destiny is going to be pretty much one of the big players is going to consume.
Well,
eventually, I suspect Microsoft, because they already have stake, and then everything is going to be much more expensive.
Well, I think
now,
I think in the long run they're going to get those government guarantees that they talked about, but they're not going to get them with a would-be $1 trillion equity.
but that's not the problem. There's another problem there. Chinese are much cheaper.
Oh
incredibly
yeah,
cheaper.
well, yeah,
And
absolutely.
so eventually,
that's the real problem.
That's if we actually close our borders and we become a Soviet Union and then just dwell in our
That's
really
what's happening.
expensive and efficient AI, or if we actually become a global AI market, then basically it doesn't matter. There won't be time for government. There won't be reasons for government intervention. They're just going to be over expensive. And I would like the last word to mention, just to mention also on the issues of data centers. There's also another big problem going on there. The timeline. To build data centers takes a long time. Probably the technology from hardware to software to LLM models is going to change dramatically, which means the data centers you build in 2 years are going to be obsolete anyway. So that could be money thrown away. That's everyone's problem, including Chinese. But Chinese are much more efficient, so they can go around it.
Last question, last chance. Thank you, everyone. Great call. A lot of really brilliant people on the call today.
Listen,
I'll be in touch probably in a month. Go ahead, Tony.
I want to get in touch with Mike about.
I'll set that up, Tony.
Okay, thank you.
Yep.
Thank you.